Alright, hi everybody, this is going to be a super random video. I'm actually on holiday right now, but I feel like I need to drop another video on my YouTube channel and actually have a topic I want to cover today, which is Meta's Blockbuster Q2 earnings. And actually sold my Meta position, which is sort of big news too. So I want to talk about this too, and I did this before the quarter. So I'm here to get some critical comments about that decision. But hear me out. So let's talk about Q2 first of all. I can't give you the exact numbers here. I just have a few. I'm going to give you a few numbers off the top of my head here. So the Q2 result was really strong. So revenue was up, I think, above 20%. Profits were up above 30%. The EBIT margin shot up to 43%, if I'm not mistaken. Maybe most importantly, the guidance was also raised. So Meta is expecting to continue on that upward trajectory in the coming year. So, well, just looking at the numbers, this was a fantastic quarter. Actually shared a blog post today in which I sort of provided a contrarian perspective on the quarter. Because on Twitter, maybe also driven by the fact, I mean, it was a Blockbuster quarter, don't get me wrong, but certainly also driven by the fact that the share price in the after hours shot up above 10%. This sometimes drives the narrative too, so everyone was cheering the quarter, and I think it was a solid quarter, don't get me wrong. However, I think there's one element that was, well, not really talked about much, and that investors aren't really, well, highlighting, that I think deserves investors' attention, and that's the CapEx guide. So I'll get to that in a second. So I just mentioned a lot of positive things, and I'm not bearish on Meta, so please acknowledge that. Just because I sold it, it doesn't mean that I think the stock will go down. I do expect Meta to, the stock at least, to grow sort of in line with earnings and the earnings power of Meta, which hopefully will be in the teens, maybe low teens, maybe mid-teens, maybe higher. I don't think that's super likely. Certainly one scenario, who knows. But I do expect the stock performance to come from an increase in earnings and not so much from an uplift of the multiple. So that's already one of the reasons why I actually sold my position. I think the sentiment regarding Meta is very favorable right now. It is completely different to when I made my position and build it. Basically, when the stock was declining all the way down to below the $100 a share mark. Back then, no one wanted to touch Meta, and I feel like the sentiment is completely different today, which is justified by great business performance, of course. But I think this is also reflected in the share price right now, which is why I believe, and I said it before, that going forward, the heavy lifting will have to be done by the increase in earnings. I think the multiples right now that we're looking at are an EV to sales multiple above 9 times, an EBIT multiple that doesn't sound all too demanding, especially now that EBIT margin continues to trend higher. I think last time I checked it was around 25 times. The free cash flow multiple, partly driven by the heavy CapEx that Meta is engaging in, was in the 30s. And if you adjust free cash flow for stock-based compensation, the multiple was actually above 50. So that's certainly not a cheap valuation anymore. And, well, in my forecasting, I would definitely not feel comfortable betting on that multiple expanding further. So as a result, well, the stock returns going forward will have to come from increases in earnings, which I think Meta will deliver. How high these increases per year will be, I don't know. So that was one of the reasons why I sold. The other one was, well, big tech has been criticized for the very heavy capital expenditures they are engaging in for quite a while now. And Meta is not shying back here itself. They are very aggressive, arguably of all of big tech, the most aggressive. If you compare CapEx to revenue or operating cash flow, that metric will be the highest for Meta among all of big tech. And I would argue that Meta definitely has to do that. I think it's the rational move to do, because Meta is very reliant on its core business, and Zuckerberg has been very, well, vocal about him not disliking the dependency it has on of other platforms. So even though it might be the rational thing to do for Meta specifically, that doesn't mean I have to continue holding onto Meta, because the money that is spent right now is really high. So again, I wrote a blog post on that the other day in which I highlighted how the numbers work. I would encourage you to take a look at the post yourself. But essentially, if you're spending 70 billion, that's like, you would have to check how many companies of the S&P actually surpassed that 70 billion market cap threshold, it's not going to be all of the S&P members, I'm quite sure. So that's a lot of money. And if you want to earn, call it a 10% return on that $70 billion investment, well, you better increase your earnings power by 7 billion next year, and then even more the year after, and so on and so forth. And oftentimes these investments are backloaded, which means you won't see an immediate return, which means, well, if you only earn an actual return, so an incremental increase in earnings or free cash flow in year 5, well, that increase has to be way higher than 10% to justify just a 10% return. And 10% would be my hurdle rate, because I would assume that that is what I can earn by just investing in a broad market index. Now, in Q2, and during the earnings call, Meta actually flagged that they are, well, expectedly going to continue hiking their capex. And it is now assumed that over the next year they are planning to spend $100 billion in capex. And they even considered, again, that's a comment they made on the earnings call, using some debt to finance that investment. Because if you're going to spend $100 billion in capex, well, you better have the cash flow to show for it. I think in Q2, the quarter alone, Meta posted operating cash flow of 25 billion. So if you analyze that, well, that's 100 billion. So as you can see, if Meta plans to spend that much money on capex, well, it has to see where that money has come from, and it might no longer be able to finance all of that capex internally, which, well, it is a risk. Zuckerberg is all in on this. He has been all in on the metaverse before, which didn't pan out the way he imagined. He was very vocal about, well, how he thinks this bet is going to play out, and it didn't. I know Meta, I was a shareholder and I still own Meta in my parents' portfolio, and my wife still holds it. So I think I have the ability to hold two contradicting views here at the same time. I'm not bearish on Meta, don't get me wrong, but I don't think I will earn home run returns in that stock, and that's partly by the massive capex, where I'm just unsure what the return on that capex spend will be. And I'm not sure if Meta itself knows, because it is such a unique, you could say opportunity, but it is such a unique investment where you can't rely on base rates that historically have been earned on these kinds of investments, that you just don't know. I guess Meta has internal data that could justify it. I think there was quite a well-known interview with the CFO of Meta a few weeks ago, where she highlighted that they're actually tracking the return on investment quite closely. So maybe that gives you a little bit of confidence in these investments. But I would just put a big question mark behind what kind of returns will be earned on these massive capex investments. They could be spectacular, but they could also be disastrous. I really don't know. And that question mark made me exit Meta. I'm happy to accept criticism here. I made a great return on Meta. I think from the lows, at one point the stock compounded by rate above 150% annually over that 3-year time frame. So that's more than any investor can hope for, and I'm very at peace with my decision. And who knows, I'm rooting for Zuck, don't get me wrong. I'm a big fan of him, of the company, of the products they offer. Yeah, and I think with that I'll call it a day here. Let me know how you like these more casual videos. I really just sat down on holiday and shared a couple of thoughts I had, and obviously did some preparation by releasing a blog post earlier today. Yeah, that's it. Take care.